Hello and welcome to traders and investors, and I'm glad to present you the daily market review prepared by analysts and experts from fx.co portal. Here we go. And we're starting with euro-dollar pair with Din Lao. On Wednesday, the EURUSD pair reached the 100% retracement corrective level, 1.1574. Rebounded from it and rose to the 127 Fibonacci level at 1.1712, from which it also bounced. As a result, the latest reversal favored the US dollar, and on Thursday morning the bears resumed their attacks toward the 1.1574 level. Another rebound from this level will again work in favor of the euro, with a potential rise toward 1.1645 and 1712. A consolidation below 1574 will increase the likelihood of further decline toward the next corrective level of 76% at 1.1454. The wave structure on the hourly chart remains simple and clear. The last completed downward wave did not break the low of the previous wave, and the most recent upward wave failed to surpass the previous peak. Therefore, the trend remains bullish for now. The lack of real progress in US trade negotiations, the low likelihood of trade deals with most countries, and new tariff highs continue to paint a grim outlook for the bears, even though they have been active in recent weeks. In the past few weeks, the US dollar has strengthened significantly, although the news background has not always supported this move. However, yesterday the dollar sharply fell across the market. This happened in the evening, and the bulls failed to build on their success. By Thursday morning, the pair had returned to the levels from which the previous growth began. On the 4-hour chart, the pair has consolidated below the 1.1680 level, as well as below the ascending trend channel. Thus, the bullish trend is beginning to shift toward bearish, though I would be cautious with such conclusions. Despite the dollar rising for the third consecutive week, its fundamental foundation remains weak. We believe that the market is not ready to buy dollars on the multi-month or multi-year horizon. Traders still don't understand what the trade war will ultimately mean for the US, so the current dollar growth appears more like a dissipative rally. Here is Laurie Bailey with pound sterling dollar pair forecast. Let's have a look. An interesting nuance in yesterday's price behavior of the British pound is that it moved into a correction after preliminary reaching the support level of 1.3369, which it had not reached on Tuesday. This indicates that the level is effective, and another upward rebound from it possible if market considers yesterday's move insufficient. Only a consolidation below this level, 1.3369, would open the way for further decline toward 1.3233. Between 32.33 and 33.69, the price spent 22 sessions in May-April, so it is possible that it is aiming for this range again, where it may be also encounter the upcoming Federal Reserve rate decision. The decision itself is expected to be hawkish, given that inflation in the US is rising. Therefore, it would be more convenient for the pound to approach this event from lower levels rather than from higher ones. On the 4-hour chart, the price is moving below both descending indicator lines. The trade balance line, it's a red line on the chart, and the blue one, the MACD line. And the Marlin oscillator remains in negative territory. The trend both here and on the daily chart remains downward. That's all for today. See you online soon.